All right, good evening, everybody. My name is Daniel Sines with the Los Angeles Police Federal Credit Union. Just wanted to welcome you all to the retirement planning webinar, hosted by Patrick Infante. He's LAPFCU's internal financial advisor and certified fund specialist. Just a bit of housekeeping. Please note that this is being recorded, so this will be sent to you tomorrow and will be posted to our YouTube page. So if you want to review it, there's some information that you want to gather and refer to later. You'll get this email to you, and it'll also be posted on our YouTube page. You'll notice off to the right, there's a question and answer column, so feel free to put your questions or ask your questions in those columns, and we'll get to those questions at the very end. We're going to allot some time at the end for questions and answers. And with that being said, I'd like to introduce you all to Patrick Infante. Take it away, Patrick.
Thank you, Daniel. Thank you. Good evening, everyone. Thank you so much for taking the time out of your busy days. As you mentioned, my name is Patrick Infante, financial advisor, certified fund specialist. I've been an advisor for about 30 years now, and glad to be part of the team here at LAPFCU with investments in retirement. Tonight's presentation, of course, retirement planning, a webinar, the importance of planning early in retirement. We're going to go over a lot of different things here in these slides, and like Daniel said, we're going to have time at the end for questions and answers, right? So basically, let me jump here to we have an agenda here for tonight. It's going to be our retirement savings mantras. Okay, savings mantras. We're going to go over the 5 steps to help achieve retirement savings success. We're going to discuss how much money you're going to need in retirement, right? And everyone's going to have a different situation depending on your dynamics. And then at the end, we're going to go over drop options. So we're going to cover quite a few things. And again, make sure that everyone has some kind of the takeaway here is to make sure that you kind of picture what retirement is going to mean for you, both from a financial perspective and from a lifestyle perspective, right? And so we want to make sure we have a goal in mind, a plan in place, and we're kind of monitoring that as we go forward. This is our disclosure here. Again, I'm with LAPFCU, Investments in Retirement. As most of you folks know, investments in the market typically may lose value, as it says here, can go up or down, right? They do have good returns, but they can go up and down in value. They're not insured by the credit union. They're not guaranteed by the credit union. So typically in investments, as you know, we were typically in the market, right? Stocks and bonds. However, you can do protected products in investments, and I'll go over that a little bit later in the slides. But this is just a general disclosure. Generally, when you're in your retirement planning, 401k, 457, government plans, you're typically in the market, large cap growth, right? Technology, things of this nature, which are stocks that do go up and down in value, but again, the returns are there, worth it. I want to start off with a somewhat sobering statistic here, folks. On average, Social Security only replaces about 40% of our income. Okay, on average, 40%, which is pretty low. I don't know about you folks, but I could not really get by comfortably on 40% of my income. For some folks that are in a higher income bracket, that may be a lower percentage, and folks that are in a lower income bracket, that percentage may be higher. Okay, this is just a general average. But something to be aware of. That's why, again, we're focusing on retirement planning. No matter what age or what stage in life we are, we want to just make sure we have a plan in place and a goal in mind so we can work towards that and make sure we're on track. Our 2 savings mantras today are going to be basically start saving as early as you can, and we'll go over that in later slides. You'll understand the importance of starting as early as you can and also saving as much as you can. And that'll tie together later again why these 2 things are so important here as we go forward into planning for retirement. Okay, there are some surveys out there that ask folks, will you have enough money to live comfortably throughout retirement? When surveyed, only 18% of folks felt very confident, very low. 18% were confident they'd have enough money to be comfortable. 46% felt somewhat confident, and 36% of folks were not very confident at all that they would have enough money to be comfortable in retirement. So over a third, really, that were not confident at all. They're participating, maybe in their plan, but they're not really sure, right? They're not sure. They're trying to do what they can, but they don't have a plan in place. And, it's a very a big percentage there. When folks were asked, are you doing a good job preparing for retirement? 22% felt very confident. 44% were somewhat confident, and 34% were not very confident at all. Same thing again. They're participating, maybe they're not sure they're putting enough money in. So again, a big percentage, about a third on both of these categories, that really aren't very confident at all that they're going to be fine in retirement, right? Okay. Now, the idea here is when we retire, we want to maintain our lifestyle in retirement, right? By saving as early as you can and save as much as you can. Very important, right? When we retire, we're living longer, right? Typical average, retirement age could be 20 years, right? 20 years, maybe 30. We're living longer. I have clients that are in their 80s and 90s. So we're living longer, and generally we want our retirement money to last longer, right? Not the old typical 20-year plan of retirement. We want to make sure we have enough to get us through all those years in retirement so we can live comfortably. Okay, now let's take a closer look how we can prepare for this. Okay, a couple steps here. First of all, we're going to go through how to choose your savings vehicle. 2, starting early, very important, you'll see why. 3, you want to increase your savings rates whenever you can, right? You want to try to pay yourself first, take care of your retirement, take care of your family. Number 4, don't forget about healthcare expenses. Healthcare can add up quite a bit as we get older, right? Especially depending on your family dynamics, how your family, history has been. And number 5, you want to seek professional advice if you need it, right? Maybe you're doing your own thing, you're in the market, but to get a second opinion is always good to make sure, hey, how's my return for the year, right? Am I on track? What's my goal? Maybe you don't have a goal. You want to make sure and do a projection as to what your value might be when you do retire. So these are all things we can do here for you at the credit union. I'm in the Academy branch, by the way. Daily, I go to Van Nuys by appointment. Some of the members that move out of state, we do video calls, right? WebEx, Teams meetings, and phone call meetings, right? So we want to make sure you get advice, and we're here to help you out to make sure you're on track. Okay, first of all, choosing your investment vehicle. We're going to have employer-sponsored plans, such as your 457 with the city, deferred comp, right? You have 401ks. And then you have 403Bs if you work in healthcare. So these are employer plans, of course, typically the best place that I like to tell folks to put money away. Then we have IRAs, individual retirement accounts, again, commonly known as IRAs. And both of these come in 2 options: traditional, which is pre-tax money, right? Money that's never been taxed. So you put the money in before you get paid, the money's been contributed. And then you have the Roth options. Roth options are after-tax contributions, so the money's already been taxed, and when you take it out, that's tax-free. The traditional, right, pre-tax, you can write it off, of course, and you take the money out, it's taxed as you take it out in retirement years. So again, traditional and Roth, you have both of these options. Some folks, or most folks, contribute to both, and we can discuss the benefits of both as we go further into the presentation. Okay, as I mentioned here, money contributed to pre-tax basis, so the money's never been taxed. All the earnings grow tax deferred. So all the growth, all the interest you're making is tax deferred. You're not paying any taxes, of course, along the way in the retirement accounts, whether it's a employer plan or an IRA, individual retirement account. Number 3, your employer may choose to match, right? So if you're putting in 5%, 10%, whatever that number is, your employer might match and give you 3%. They might even match dollar for dollar, right? Some folks, I've come across that don't even understand the market and how the market works, so they don't even participate in their employer plan. So not only they're not preparing for their future and their retirement, but they're also not benefiting from the employer trying to help them, right, build their nest egg. So really, you want to make sure that you are participating as much as you can. As most of you folks know, that contribution is flexible. You can increase it, decrease it. And again, if your employer is giving you a contribution there, that's really nice of them because they're helping you build your future nest egg there. Most of these plans are consisting of mutual funds, right? Mutual funds in this case with the city of LA, it's Voya. Voya is a money manager like T. Rowe Price, Vanguard, Fidelity. Most employer plans are going to be run by these companies, right? Voya, Fidelity. And you have mutual funds. One mutual fund, in the case of city of LA, Voya, you have large cap growth. Large cap growth in this case is the S&P 500, right? The S&P 500 index is our benchmark for growth in the U.S. It's the 500 largest companies in America from different sectors, financials, healthcare, technology, from all sectors. So it gives you a good gauge of how the market's doing. And again, in your employer plans, you're going to have mutual funds. One position is going to be very diversified. For Voya, the large cap growth, it's actually the S&P 500. So if you put money into the S&P 500 large cap growth, your money spread out amongst the 500 largest companies. It's very well diversified. You have a broad approach. And you're not taking a lot of concentration risk, right? Concentration risk, if you put money in one stock, you're going to have a lot of risk there. And so you want to do mutual funds there. Some plans may have exchange traded funds. These are also known as ETFs. Very similar mutual funds, ETFs. One position is going to be a basket of stocks, typically anywhere from 100 to up to 500 stocks in one holding, in one position. So very diversified. As I mentioned before, on these pre-tax plans, withdrawals are taxed at your income rate when you retire. So as you take money out, you're going to pay taxes, federal tax and state tax. So for most folks that don't have a pension, when you're working, you're paying maybe 24% federal tax, maybe 9.3 for state tax. It goes off your income, right? If you want to find out where your federal tax bracket is, you can easily Google 2026 federal tax brackets. And it goes off individual, or if you're filing jointly, there's an income gap, right? So depending on your income, you might be at 24% federal tax. You might be at about 9.3 state tax. The idea here is when you start taking money out and you retire, your federal tax bracket could go down maybe to 12%, right? So if you're making less income, maybe you're not going to be paying 24% federal tax. So you take money out of your retirement accounts, you're going to pay less tax and hold on to more of your money, right? For most folks that have a pension, good and bad, you have a pension, which is great, but you're probably always going to be in a higher tax bracket, right? So that might be 24, for the long term, which is okay. And on that you want to plan. As you're putting money back into these plans, maybe that Roth option is going to be a better option for you, because if you're going to be in a higher tax bracket, in retirement, you put that money into the Roth now, after tax money, when you take that money out of the Roth, there's no tax at all. For most folks, the pre-tax is a good way to go again, because you're putting that money in. It's also a write-off. You tell your CPA, what you put in. So if you're making $100,000 a year and you put in $10,000 into your employer plan, you only report income of $90,000, right? If you're making $100,000, you put $20,000 into your employer plan, your reportable income is $80,000. That's a write-off. And again, when you take it out of that pre-tax, ideally, when you're retired, maybe you're in a lower tax bracket, depending on your income, right? And that changes every year slightly. Also on the employer plans, 401k again, 457, deferred comp, you should be over 59.5 to avoid a 10% penalty. So when you start taking money out of these employer plans, there's a 10% penalty if you're not 59.5. So you got to pay federal tax, pay your state tax, and 59.5, 10% penalty. However, if you work for the city with Voya, City of LA, in the 457 deferred comp, there is no 10% penalty. So be aware of that. It's a little benefit there. So if you're going to retire prior to 59.5 and you're working for the city, you want to have some money there in that deferred comp. So when you take it out prior to 59 and a half, you're not going to have a 10% penalty, which is a big benefit. You have to pay federal tax and state tax, but again, no 10% penalty in the employer 457 deferred comp. Anybody else that works at Costco, wherever with credit union, you take money out prior to 59 and a half, you got the 10% penalty along with the federal and state tax. Okay, so be aware of that. Keeping money there. Again, if you are retiring early, you've done your term and you're going to, retire earlier than 59 and a half. Okay, all these plans, of course, like I mentioned before, they have the pre-tax and they also have Roth options. Roth options, of course, again, are funded with after-tax money, and that can be withdrawn tax-free. The current contributions, by the way, have gone up. For this year, the contribution for your employer plan, the limit is $24,500. It's quite a big number, right? $24,500 limit. If you're over 50, there's a catch-up of an extra $8,000. So your total contribution limit, if you're over 50, is $32,500. These are big amounts, right? For anyone to put in $24,500 per year, that alone is going to kick your retirement balance up and your wealth up, right, every single year. If you have an employer match, by the way, and your employer's matching, that doesn't count towards the limit. So you can put in 24.5 if you can per year. Whatever your employer puts in for you, if they're matching, that goes on top of it. So that's an extra benefit there. So these are big numbers to hit. And as you know, you can increase this, right? You can adjust your contribution percentage. You can increase it if it's too tight. Your budget's too close. You can always scale it back. Ideally, you want to try to get as close as you can to these limits every year. That's why, I tell clients, hey, if you're going to put money away for retirement, or they say, Patrick, I want to build a retirement account. My first question is always, do you have an employer plan, a 401k, 457? If they do, I say start here first because you can put a lot more money away through the 401k or the employer plans, right? A big, big amount that you can contribute every year. Okay, IRAs, individual retirement accounts. Individual retirement accounts, first of all, are typically going to be where you're going to build your retirement account if you don't have an employer-sponsored plan. So if you're working somewhere, they don't have a 401k, you want to set up an IRA, individual retirement account right away for yourself and start funding that to build your retirement account. Also, IRAs are typically used as a rollover. So when you're working for a corporation, for the city, when you retire, typically it's very advisable to roll your money into an IRA, again, an individual retirement account. By getting out of the employer plans are somewhat limited. In Voya, you have about 12 choices: large cap growth, mid cap, small cap, international, and then you have some income funds. Very similar to most employer plans, give you about maybe a dozen choices of where to invest. When you come out of the employer plans, okay, you roll into an IRA, you do the rollover. Of course, it's a non-taxable event. It's a direct rollover from one tax-deferred account to another tax-deferred account. When you go into the IRA, it opens up so many more investment choices you can do. Let's say you're stuck in Voya, the city, okay, or with T. Rowe Price, Fidelity. You go into the IRA, you can bring in a variety of different money managers: BlackRock, American funds. You can do stocks if you want. And also you can protect your money. You can be in growth with protection. We know that when we're in the market goes up and down, right? There's no protection. There are strategies these days where you can be in the market and you can have a buffer, 10%, 20%, 30%. 100% protection, right? There's a trade-off, of course, but still you can have different levels of protection in the IRAs. You can bring in a lot of different investment choices. So a big benefit whenever you retire to roll over into an IRA, again, an individual retirement account. Also, you can do a rollover with most employers through what's called an in-service withdrawal if you're over 59 and a half. So if you're still working at 59 and a half, you can do a rollover again through the in-service withdrawal. Most employers offer that. That way you can get your money out and hopefully doing some better investments and kicking up the return. Most of these IRAs, actually all of them, are held by a custodian, such as a bank, a credit union, or a brokerage firm, right? Like where I'm at. So that's what you want to do. You can roll your IRA into a bank, credit union. The drawback there is you don't have many choices to invest, right? You have a CD, really. CD rates are anywhere from 3.5% to 4% currently. So most folks will roll their money into an investment account, a brokerage account. Once your money's in that IRA, a rollover account, again, you can do CDs if you want. You can do growth. You can do stocks. You can do so much more, build a quality portfolio. And if you say, hey, I'm retired now, I'm getting older, I want to have some protection, you can put some protection in there by, having some protected growth as well. And these are strategies we can discuss on a one-on-one basis, anytime. As I mentioned here, you have a much larger universe of mutual funds, BlackRock, American Fund, Franklin Templeton, all the big money managers out there. And for my clients, when we're looking for growth, large cap growth, right, tied to the S&P, I typically bring in about 4 to 5 large cap managers that outperform. I'll bring in 4 managers that have a good track record, maybe some technology in there, and you really build a portfolio of some of the best and smartest minds on Wall Street to manage your money. And again, as the last comment here, other investment types available, which I kind of covered already, different strategies, protection. Again, you can do CDs if you want. And as far as if someone says, hey, I just want a fixed rate, we can get products that pay 5%, right? 5% or higher. So depending on what your objective is, if you want to grow your money or continue growing it, we can look at those strategies. But a lot of different types of investments available outside the employer plans in the IRAs, individual retirement accounts. And again, you can set this up on your own. If you don't have an employer plan, we can do those all the time for you and help you manage them. Okay, contributions, as I mentioned, are tax deductible. You put your money in, it goes in pre-tax. You get your paycheck, the money's already been contributed, right? You don't even see it. You know you're contributing. That's deductible. And if you're making 100,000 as an example, you put in 20,000, your reportable income is only 80,000. So you're paying less taxes, right, on your income, and you're putting money away for retirement. As I mentioned earlier, investments compound tax deferred, meaning all the earnings are not taxed until you start taking them out, right? Tax deferred. And there are products, by the way, out there, as a side note, outside of IRAs where you can get fixed rates and that interest is tax deferred as well. So as a side note, apart from investment accounts, there are obviously non-retirement investment accounts that we can set up where you can do growth or income, and there are tax deferral products and of course, other growth products. Withdrawals, as you take money out, are taxed at your income tax rate. Ideally, if you don't have a pension, you're going to be paying less taxes, maybe 12%, maybe 10% federal tax. So you want to take those out as you retire. Again, and if you're in a pension, with a pension, you're going to have a higher tax bracket probably still. So you want to maybe look at the Roth option. Again, you have to be over 59 and a half to take the money out without a 10% penalty. That again is waived for the city, so that will not apply to the deferred comp, the 457 government plans. But other government employer plans, there is a 59%, 59 and a half, 10% penalty if you take that money out. As we discussed, there are Roth options as well, which are funded with after-tax money, and that money comes out tax-free. Again, that's a favorable way to go if you have a pension and you know you're going to be in a higher tax bracket. There was a big push years ago when people were doing Roth conversions. You might have remembered that. That was the thought that, hey, I'd rather pay my taxes now because I think taxes are going to go up, and they actually have gone up, right? So a lot of folks did a conversion way back. But again, it depends on your individual situation. If you're going to be retired and have less income, if you're only going to be living on Social Security, that's going to be your only income source, and whatever income you can get from your retirement accounts, then we kind of run the numbers and see what the best option is for you. Here's the thing, on the IRAs, the contribution limit is only $7,500, okay, per year, a lot less than the employer plans. That's why I mentioned earlier that I always tell folks, if you have an employer plan, fund that first, because the contribution limit is $24,500 versus $7,500, right? You can see the difference in how quickly you can grow your balances in the employer plans. Plus, if you get a match, right? If you're over 50 years old, you get an extra catch-up of $1,100 versus $8,000 on the employer plans. So total of $8,600 if you're over 50. If you're not 50 years old, contribution limit again is $7,500. A lot less, but at least it's something, right? You can still put that in, $7,500 a year, and write it off against your income, right? You tell your CPA, I put my $7,500 in, and they'll deduct that and put it into your tax return. Okay, here's something that kind of ties to why starting early is so important. It's called the rule of 72. What you do is you take your expected rate of return. Let's say you're getting 4% on your money. You take 72 divided by 4, your return rate, and your money will average double in about 18 years average, okay? If your money's earning 6%, 72 divided by 6, your money will double in about every 12 years. Okay. If you're getting 8% on your money, 72 divided by 8, your money will double every 9 years approximately. And if you're making 10% on your money, 72 divided by 10, your money will double about every 7 years. Okay. The market historical return the past 40 years is about 11%. Okay. So you're looking at about maybe 6 to 7 years for a double. However, this year, the market, the S&P 500, when I talk about the market, of course, it's the S&P 500, the benchmark, how we compare growth. The S&P year to date is up about 14%. That would mean it would double about every 5 years, okay? And it has actually done about that, over 70 something percent in the last 5 years. The technology index, known as the QQQ, the tech index would include all the big tech companies, Microsoft, Apple, Google. That's up about 16% for the year. That will double in just over 4 years. So again, if you have money in your plans, the question is how many times can you double that, right? And the more you have in there, maybe you can double it every 4, 5, 7 years. It's going to help the money grow and keep doubling. You try to double that amount as much as you can through your retirement years. So that really ties back to why one of our mantras is starting as early as you can and saving as much as you can, so you can try to get as many doubles on your return as possible, right? And then make that money work for you. Okay, increase your savings rate whenever you can, right? Pay yourself first. So maybe you want to make it a New Year's resolution every year to increase your savings contribution. If you're putting in 5, 8%, you want to try to kick that up and just make sure that every year, if you can, pay yourself more. Another way you can increase that is by cutting down on non-essentials, right? We all sometimes go out, go to Starbucks, go out to lunch. If you take time and you kind of add up what you're spending, it could be several $100s, right? It could be a car payment. So we don't really, pay attention to that. I do the same thing, but it does add up. Non-essentials, right, to the third bullet point. Cut down on non-essentials, right? Go through and see what you're spending, and maybe take lunch to work a couple days a week instead of eating out. Maybe make coffee at work, or bring it from home, because this money adds up. You'd be surprised how much you are spending on non-essentials throughout the month. If you have an opportunity to increase your contribution, maybe you get a pay raise or you get a bonus, pay yourself first, right? Pay yourself and take care of you and your family first, and put that money in for your retirement. When we're younger, we don't think as much about retirement. I didn't start to my 30s, but it makes a big difference, right? And you want to have a target. You say, hey, you know what? I want to have $1 million when I retire. $1 million is not what it used to be, but if you have $1 million, there's 2 stages, by the way, in retirement planning. There's the growth stages when you're trying to grow your money, and try to get to that certain number. Maybe it's 1 million, maybe it's 500,000, maybe it's 2 million, right? Let's say an example of 1 million. If you grow your account to $1 million, and then that can help you generate 6, 7, 8% or higher, that's 60, 70, 80,000 a year of interest alone. And that pays out monthly, right? So there's 2 stages again to raise, to get to the growth and the income. So again, very important to increase your savings whenever you can, to make sure you're on track and trying to hit your target number, whatever that number may be. And the last bullet point here is be smart with your budget. Again, take the time, go through your budget, write down your essential bills per month, all your non-essentials, see how much you're spending and see where you're at. You'd be surprised how much you are spending there per month on non-essentials. So you want to make sure you are smart with your finances. This is the contribution limits currently. These have gone up over the years, by the way. Again, as I discussed earlier, the contribution limit for the IRA, individual retirement account, is $7,500. Okay. The catch-up provision, if you're over 50, is $1,100 for a total of $8,600. $8,600 per year limit. On the employer plans, 401k, 457, $24,500 is the limit, which is a big difference, right? And that does not include employer match. Okay, so that's on top of this. Again, if you're over 50 years old, you can put an additional $8,000 a year for a total of $32,500. That's a big amount, right? Some people make just a bit more than that on a regular job out there, right? So you want to try to max out these numbers if you can, or get as close to. When you're getting towards the second half of the year, third quarter, and you get your paycheck, your stub, you want to see what your contribution amount is for the year. It'll tell you right there so far how much you've put in to your employer plan. So if you're getting close to this, you want to try to ratchet up towards the end of the year and try to get as close as you can to these limits every year to make sure you're maximizing the contribution limit and you're maximizing the potential growth of your money, and try to get as much money to double in the coming years as well, right? That's very important to be aware of. Okay, very important here. Don't forget about healthcare expenses in retirement. There's a cool calculator you can pull up on aarp.org. You can plug in your information. It'll give you an idea of what you could expect to spend in healthcare when you retire. And we are living longer in retirement again, not the usual 20 years, could be 30 years, 40, depending. But on average, studies have shown that a married couple retiring in 2026 can spend about 345,000 after tax money to cover out of pocket expenses. Okay, that's about 18,000 a year for a couple, give or take 17, 18,000. 345,000 over 20 years after tax, right? After tax. So it's quite a bit of money there. If you're a single person and you're retiring at 65, you're going to spend about 172,500 over 20 years for healthcare costs. That's about half of the other amount, right? 8,000 per year. So these are sizable amounts. You want to plan for this as well. Especially depending on your family dynamics, longevity in your family, any ailments folks may have had. You want to kind of prepare and just plan ahead because again, healthcare can get very expensive as well, and it can put a big dent in your retirement accounts. Again, I talked about this earlier. Seek professional advice if you need it. Even if you're doing your own thing in the market, you want to maybe have someone just give you a checkup. I do this all the time. I had a young officer come into my office a couple weeks back. He says, "Hey, can you look at my Voya account?" At that time, the market was up about 12%. I said, "You're only up 7%. Something, we got to adjust this." So you want to make sure when you're trying to grow your money, if the market's up, let's say 13%, 14% for the year, you should be really in line with that, right? You want to make sure your money is keeping track with the market and it's growing as best it can. I myself listen to analysts and economists every day, and I try to guide my clients to where that puck's going. That's right. So we want to say, hey, the market's up 13, 14. You want to make sure that you're in large cap growth. Even my retired clients are in growth because the outlook is still positive, right? There's a lot of headline news, but overall the market keeps going up. Last year is a good example. An average market correction, folks, is about 10%, right? Average. Last year is a good example. The market started off last year at about 4%. In February, we're already up 4%. Then we had a pullback. We were down about 10% going into late March. 10%, okay, average pullback. Then the tariffs came out, right? So-called Liberation Day. We dropped 10 more percent. On April 8th last year, we were negative 20%. Okay, tough way to go into April, right? Negative 20%. And you know what? That's why when you go into the market, this is not money you need in 3 months, 6 months, right? For a certain expense. You got to give your money time, at least minimum a year or longer. And the takeaway here is last year, the market did 18%. So it bounced off that bottom of negative 20. It bounced 38% from that bottom. And I had clients call me, "Hey, Patrick, what do we do?" I said, "You know what? All the analysts, I'm not an analyst or economist, but these professionals I listen to daily are saying, stay the course, the economy's strong. The reports show that the economy, people are working." And sure enough, you did 18%. I had one person get out, or anyone that does get out at the bottom, they can't take it. What they do there, they locked in a loss, and they're probably sitting in a money market somewhere, right? So it's really hard to time the market. You have to be patient. And again, I'm here to give advice and tell folks what I'm hearing, what they should be doing. And again, 18% last year. This year, somewhat similar. The market was up. The war started. We were down about 5 or 6% in the first quarter. Now the market's up 14% year to date. So we're having a very similar year, not as much of a pullback. But again, we're up probably going to hit the high double digits by year end. So really for me overall, the headline news, a lot of concerns, but what matters is folks are still working, they're spending money, and they're investing, and they're spending, and they're buying goods, and it's driving corporate earnings up. So that's what's driving the market up. When you're investing in the market, you're a shareholder, right? You're investing in all the big companies, McDonald's, IBM, General Electric, Microsoft. So by being in the market, you're a shareholder, and you're participating in growing your money and growing your money with these corporations. So really, you want to have a long-term approach. You don't want to get shaken out on any volatility. You got to know there's going to be up and downs. That's why the market has a good return. There's more volatility, but there's higher returns as well. Okay, something to be aware of. Again, the last 5 years, S&P has done over 71% in 5 years. It's a big number, 71. Technology is closer to 90. So again, all my clients, by the way, have a certain amount of tech in their portfolios. We can always do large cap, blue chips, which is great. Those are safe. If you want to add in international, we do that, but typically we like US and we'll put in a certain percentage into technology. If you put in 10, 20% in technology with the S&P 500, your returns going to be higher than the 14 where we're at year to date, right? Most of my clients are up more than that. So definitely something to be aware of. You're looking for growth. You want to make sure you're getting advice and your allocation is correct for what's going on in the economy. And by the way, on that note, we do have analyst calls, economist calls that folks can join in. If you ever want to listen to those and hear what they're saying, just send me an email as well, and I can keep you in the loop on those. I just went over most of these. Financial advisors can help you determine your approximate savings goal, right? How much you need to have in retirement. This is going to be very customized, depending on your situation. I had one member come in. She was in her early 30s. She wanted to have $2 million in retirement. So what we did, we saw how much she had currently in her retirement account, how much she was contributing. And I said, okay, if you want to get to $2 million, you got to ratchet up a little bit. We got to contribute a little bit more. But then we hit the numbers and she started increasing her savings every month. And we said, okay, on this projection, you're going to have $2 million when you retire. So this is where we can help depending on your particular situation, what your retirement goal is going to be. And we also want to factor in, factor things like inflation, your future healthcare expenses, life expectancy. And again, investment returns, that's easy to do. We don't know the future, but we can back test portfolios to see how they're likely to do over the next 5, 10, 20 years and what your balance might be, right? You can tell me, hey, this is my balance currently. This is how much I'm putting in, and we can get an idea of what the value is going to be into your retirement. We can develop an investment strategy to help address your long-term needs, of course, retirement, and also we can address your short-term goals, right? You might have a short-term goal of buying a home, buying a car, so we can have budgets and goals for both short and long-term planning. We also want to discuss professionally managed investment solutions. Again, these are mainly solutions that are available in your employer plans and outside of the employer plans. As you retire or you take money out of your employer plan into IRAs, all the available options that are available to you. Within Voya, by the way, you can have money in the Schwab platform, the Schwab Personal Choice Retirement Account. So that will still be part of your 457 deferred comp. That gives you more investment options, and I can help you manage your money on that platform as well. The idea is there, you're going to have a lot more choices of how to grow your money, different income strategies. So Schwab PCRA, again, Personal Choice Retirement Account. If you're not familiar with that, I can give you some more insights anytime on how that works. And again, we want to talk to your clients and your advisor regularly, maybe once a year, 2 or 3, 4 times a year. Some clients I talk to every month. I'm in the office every day, so depending on what's going on, we want to make sure that we're there to guide you, to answer any questions you have, and make sure you're on track as we're adjusting for your retirement goals. Here we discuss what's your number. I kind of touched briefly on this. We all have a different number. Well, we all have a different target. Typically, studies show that you should plan to save about 75 to 80% of your pre-retirement income, just as a general rule. Okay, try to save 75 to 80% of your pre-retirement income. Some folks may need more, and some may need less. And we'll see in what cases they might need more or less, such as you might need less if maybe your mortgage will be paid off. So if you don't have a mortgage, you're going to need less money, right, than that 75 to 80% when you retire. Also, maybe you plan on downsizing to a smaller home, maybe a smaller home with a lower mortgage payment. You're going to need less money. Maybe you want to relocate to a less expensive city or maybe out of state. Right, that'll cost you less. If you are going to relocate, by the way, out of state, you want to wait till you move out of state to take money out of your retirement accounts, of course. If you start taking money out here in California, you're going to be paying about 9.3 or more for state tax, right? So if you are planning on moving maybe Nevada or other states that have no state tax or a lower state tax, you want to make sure you wait till you move there before you start, distributing your money out of your retirement accounts. Also, you might need less money if you plan to work part-time when you retire, right? Some folks may want to do a side business, work for themselves, and keep busy. So if you have other income coming in, you might need less money in retirement. So that's another factor. Also, maybe you anticipate other sources of income. Maybe you're going to have some income from your investments, right, through your retirement accounts. Maybe you're going to have some Social Security benefits that you've had from other jobs. That'll also be a factor that we can work into the equation. And maybe you're no longer going to need to support family, right? And so that's going to be another situation where you'll need less income than the 75 to 80% of your pre-tax as you're planning forward. Some situations where you might need more income. You're going to have a mortgage, or you're going to continue making mortgage payments into retirement. That'll be obviously something to consider. Maybe you want to travel, right, extensively and enjoy life more. Or maybe you want to have a second getaway home. That'll be another situation where you want to plan for that and you're going to need more income, right? So you want to make sure you're building that nest egg as much as possible to generate income from that. Maybe you're going to expect higher healthcare costs, right? That's going to be another factor. That's going to be a budget we want to plan for. And maybe you're going to need long-term care. This is a big one. Long-term care can really be, a dent to our budget and our savings. Long-term care can be several $1,000s a month. So as we get older, we don't think about this, but you might need assistance, right? Maybe you need someone to come to the house and help you do certain things, right? This is an important one, long-term care. There are, by the way, some life insurance and some long-term care policies out there that you can pay into if you want to have some kind of safety net for long-term care. Also, in the state of California, if your loved ones have worked here and built up credits, there's a service called In-Home Supportive Services, IHSS, again, In-Home Supportive Services, that can pay your loved ones support, right? They can pay you several thousand a month for you to hire someone to help your folks out. I've done this myself. My mom's 87, and through just learning, I found the support, and the government, the city of California, pays her to pay a caregiver to take care of her. So this is a very important thing to be aware of. If your folks are elderly, they want help, someone can come to the house and help them out. If you don't have that, you want to plan for long-term care as well. It's very important because, again, it can add up to several $1,000s a month. And that's a very important thing to look at. Also, you might need more money if you want to start your own business, as I said, right? Maybe you want to fund your own business, and to get that business off the ground, you're going to need maybe some funding. You might also need more money if you're going to be still supporting children or other family members, right? As you go into retirement, maybe you want to help them out. So you want to be able to have some extra money available for them. And also, maybe you're going to need more money if you think Social Security is not going to be enough, right? Social Security benefits could be very low. It's going to be, I don't know, depending on how many credits you could have, 1,500, 2,000, maybe a little bit more, but it's not much. And another reason you might need more money, and why you may want to put as much as possible and build that target goal for your retirement account to a higher level, right? Again, we talked about maybe $1 million. If you got $1 million, I have things that pay 6, 7, 8, 9% interest. If you're getting 8 or 9% interest, that's 80 or 90,000 a year, interest alone, without touching your principal. Okay, and when I build portfolios for my income clients, depending on the economy, I'm getting income through dividends and interest, right? Because when the market's going up, you're getting income first. That's your objective. You want income, 8, 9%, 7%. Secondly, you're getting growth because you're getting income from dividends and stocks. So not only are you getting income, but your money's growing by another 5, 6%. So you're getting two objectives met by doing an equity income portfolio. Of course, you can get income through bonds and CDs. That's 4, 5, 6%, which is fine. It's more conservative. There's nothing wrong with that. But your money's not going to grow. And when we look at income, by the way, obviously, if you want income and you don't want to be in the market, you want to buy something with a fixed maturity. That way, when it comes due, you get all your money back. Because when you go into mutual funds with bonds, those can go down in value when rates go up. So on the income level, rates go up, bonds go down, right? So if you're looking for income through bonds or CDs, you got to have something that has a set maturity typically, or you have to have a portfolio that has that is interest rate defensive. And again, these are all things I won't get too deep into, but there's portfolios that have bonds that are going to protect you against interest rates. And I mentioned that because interest rates have been going up. We've had the 30-year Treasury hit 5.35 recently. So when rates are going up, they're getting better, which is great. But if you're in the wrong investments, that portion can be going down. On that note, also, sometimes you have these portfolios like a moderate allocation or a conservative allocation. Those portfolios can have 40% in bond funds. And that 40%, when rates are going up, that portion could not be working for you. It could be flat, or maybe it made 2% a year. So you want to be really cautious and look at your holdings. And I could plug all that in and show you how much of that holding is in bonds. And, it's not really helping you grow. Just be aware of that as well. Some general retirement benchmarks for savings. If you're in your 20s, you want to strive to save 7 to 10 of your annual pay for retirement. In your 30s, you want to save about 10 to 15% of your income. In your 40s, try to target 15 to 20% savings. And in your 50s and 60s, try to save 20% or more. Again, these percentages are adjustable. If it's too tight, your budget's too tight, you can scale it back. This is just a general guideline. I think more so depending on your goal, what that number is you want to have in retirement, you want to adjust accordingly to that and see where you're at, what your balance is, and how much you're contributing, and see if you're on track to hit your goal. Drop, of course. Drops always comes up. Should you go for a higher pension? How many years should you stay? A lot of folks say, hey, I'm thinking about drop. Some folks don't want to do drop. They're done. They're retired. They just want to get out. I've seen on average in drop 5 years, right? From what I've seen, the average balances 400,000 to 500,000, probably on the higher end, 500,000. So if you're working, if it were me and I got 5 years left, on a plus job, maybe in the office, something you're doing 5 years for another 500,000, I'd do that all day. So you got your pension, right? Paying into this drop account, 5 years. You got your deferred comp, your 457. It's all pre-tax. So, and how many years again? Depending, some folks might do 2-3 years. Some folks don't want to do any, but all this money, of course, you want to roll it over. If you do drop, you want to roll it over into the IRA. When you retire, or you're 59 and a half, and when you retire on this case, you put that money, the drop money with your deferred comp, into an IRA, again, the individual retirement account. It's all pre-tax. There's no tax consequence. Then you decide, okay, now the money's in the IRA. What's the plan now? Do I want to get income off of this? Maybe that balance is too big. You don't need that much income. Maybe you take some of it out for income, the interest, and you keep growing the rest of it. Maybe you grow it with protection, right? I'm retired now. I want to keep growing it, but I want to have a safety net. Let's put 20% protection on there. Or maybe let's put 100% protection, right? To protect your money as it's still growing. And distribution, of course, you want to start distributing. For my clients, when we're taking money out, it's interest alone, ideally. You're not depleting that principal. So you're taking interest out, your money's still working, and then it's going to be there for your heirs, for your kids, right? Legacy planning. So these are important factors to consider. You got your drop, you got your overtime, you got your sick days. All these are pre-tax buckets. So you want to be careful if you're not going to take those sick days and overtime all at once, because that's a big amount, plus your income for the year. You might lose half that money in taxes, right? So you want to really plan accordingly. And I can help you look at the specifics if you are getting close to retirement, and make sure you're on track and what the best approach is. Not only with 457, your drop, your overtime, and sick pay, all these are important. And I believe that is right on time for our presentation, folks. That's my contact information there. My email, of course, is patrick.infante@lapolice-lpl.com. I'm always in the branch. If the market's open and we're open, I'm there. I've been doing this 30 years. I live and breathe the markets. I'm here to share what I've learned. I've been here about 5 years. I've been at Wells Fargo. I've been at Merrill Lynch. I've seen a lot. I've been in discount firms, E-Trade, TD Ameritrade. So a lot of my career has been in the banking channel, B of A, Wells Fargo, Credit Union. I like being there in the front line with, to help members out. So we're here to help you as a team. And we want to thank you again for all your service, pre-retirement, post-retirement, and for your time out of your busy schedules tonight. Thanks again, and appreciate all you do.
Patrick, real quick, there's a couple questions in the chat.
Absolutely.
I'll go ahead and read them off. So when is the best age to claim Social Security?
If you can wait, the longer there's a schedule, it goes up. So the longer you can wait, I would wait. Unless you need it, I would wait, depending on what other resources you have. Wait the longest you can, and you're going to get a higher payout. So we can look specifically at that schedule.
Got it. Now, what income sources will fund my retirement?
What income sources will fund, meaning what will fund your retirement? Like, money coming out of retirement?
Uh, doesn't specify. But
Give
yeah,
me the
if you
question
can,
again.
what income sources will fund my retirement?
Income sources
So,
will fund your retirement. Well, of course, market returns will fund it, dividends and interest will fund it, and your contributions, right? So what's going to fund your retirement? Your contributions, your returns, of course, and your dividends and interest. So that's going to fund it, but that's going to be what's going to be funding your retirement, right? Trying to grow the balance.
yeah,
Absolutely.
got it. Thank you. All right, so I'll just give it a couple more seconds. There's
Yep,
no further questions in the chat. If anybody has any questions, feel free to drop them in the discussion or the chat, and we'll get to them.
absolutely. Yeah, and on funding retire, there's something here, I think. I got a question coming up, I think. I see a hand up from Luis. Do you see that, Daniel?
Yeah, if you raising your hand, please write your question in the chat. In the Q&A. Look for the Q&A portion. There we go. When you're talking about healthcare costs, are you referring to a situation where you don't have medical coverage from the city?
Yeah, absolutely. Yeah, generally, if you don't have it from the city, like most folks don't, right? Yeah, again, you have a lot of benefits working from the city, right? So that's going to be, you might have, you have a coverage from the city, but sometimes you might need extra, right? Depending on your dynamics, right, and your family history. But yeah, generally for the average folks that don't.
Thank you.
Yep.
For the
Done.
Luis, if you can go into the Q&A portion. There we go. What is the
Yep.
name of that program that pays you to take care of your parents again, and the
Yeah,
contact
that's a good
information?
one. That's important. Again, I found this myself through helping my mom. She's 87, knock on wood, very strong. In-home supportive services. In-home supportive, it's called IHSS. In-home supportive services, you know what? They come out to your house, they do an assessment, depending how much your mom needs, right? Your parents, your folks, your dad. They do an assessment, say, okay, you're gonna get this many hours per month. The max, by the way, folks, is 6,000 a month. It's not it's a chump change. It's a lot of money. And if they live with you and you're taking care of your folks and they're living with you and it's tax free. So you could have them living with you, someone comes over to take care of them, that money you're getting that they give to you as a you're overseeing it, it's tax free if they live with you. And even if they don't, it depends on how much they do an assessment every year, depending how much assistance they need. But again, I had no idea about this till several years ago. IHSS, in-home supportive services.
Thank you. At what age
Yep.
can a person start to withdraw from the drop account? At separation or 59 and a half?
From the drop account, you know what? You can take out at any age, really. You can take out from drop. It's all pre-tax. But after any age, the 59 and a half doesn't apply to you folks in the city employees. So that's really going to be for non-city employees. So that 59 and a half, 10% penalty is for folks that that have a 401k, not the 457 government plan, city plan. But at any age.
Got
Once
it.
you finish the drop, you're going to roll that into your, typically into your IRA. You're going to do a rollover along with your deferred comp, and it's all pre-tax. There's no tax consequence when you roll over. Just when you start taking money out, but any age. If you retire at 55, you did drop, you take your drop balance, you take your deferred comp balance and roll those both into an IRA, individual retirement account. And then you put a plan in place to see what your objective is from that point on. And I have members that are in their 70s. I say, hey, you got to start spending this money down. You have 7 figures, start traveling, enjoy it, right? We can't take it with us. So I tell members, yeah, you're right. So I encourage members to start taking trips every year, start enjoying. And I mean, we build this money up so we can enjoy life, right? And so that's the idea. So depending on every situation is different.
All right. And another question is, can I leave drop funds in Voya?
You can leave them in Voya. Absolutely. Absolutely. You can, but again, you have limited choices, but yeah, absolutely. You can do that as well.
Got it. Now, there's a question asking if it's for California residents only. I'm not sure what that's referring to.
California residents only. Maybe drop. I mean,
Maybe drop.
drop.
Yeah.
If it's referred to drop, I'm only familiar with the city of LA. I would think other states might have something similar, right? But I'm not yet. I think typically, yeah, I would imagine it's available. So if you're referring to drop, I would imagine it's available in other states or cities. But everything else typically applies across the board, right, in different states. 10% penalty if it's not a city plan, right? All the same dynamics.
Thank you. Now, regarding drawing your retirement after you move out of state, how long will it take to receive it? And does it depend on when I make the notification?
Yeah, you know what? If you're going to be living there, what the IRS is going to look for that you're living there 6 months of the year, half the year. So if you're moving out of state, and let's say you move out next month, and you want to start taking money out, when you go do your taxes at the end of the year for next year, let's say you did it this year, you move out of state, you start taking money out of those accounts. When you go do your taxes next year, you're going to show, hey, this is my residence, it's out of state now. So as long as you have, documentation, right, utility bills, etc., and you are living in that state the majority of the year, 6 months or longer, I believe it is, you're fine. You can do it this year. And then just you tell your CPA next year that you're not in whatever state you're in, California or else or other.
Got it. Patrick, we
Yeah.
got clarification on the California residents only question. Is it IHSS? Is that for California residents only?
Oh, yeah. You know what? I believe it might be. California is obviously a very wealthy state, and I really don't know. I know it's available here for sure, but other states, what I'd recommend is we call IHSS and see if other states have something similar. And I'm sure they would know. They might have got that question, but yeah, typically I know it's here for sure, but yeah, not sure on other states, but we can find out. And I'm happy to help you learn and find out with you.
Great. And another question is, if I have my city pension, do I get my full Social Security?
Oh, that's a good one. That's a good one. That's constantly changing. I have to check my resources with that because there were some provisions that were changing. If you can check with me on a one-on-one basis, I can find out for you from my backup team in my retirement planning.
Excellent.
Yeah, there was a
So,
windfall. There was a windfall provision going on, but we can find out about that one easily.
perfect. All right. I don't see any more questions. So we're about 5 minutes shy. I can give 5 minutes back to the attendees. Want everybody to take a note of Patrick's personal information on the website. I'm sorry, on the screen here. As mentioned, this is being recorded, so it will be sent to you tomorrow also if you want to refer back to the materials or need Patrick's contact information. Patrick, thank you for your time. Thank you for another great
Oh, my
presentation.
pleasure. My pleasure, all of you. And again, if you want to come in, just try to make an appointment. We get really busy in the branch. I hate to have folks waiting. Just send an email, give a call. We'll put you on the calendar so you're going to have at least an hour cut out, whether it's in person, on the phone. So we can really, typically I'd like to schedule at least an hour per person, per folks for appointments to make sure we're not, we take our time. We can do reviews, whatever it is you're looking for, better interest, growth, reviews, etc. We're here to help out.
Perfect. All right, everybody. Thank you. Have a great night and look
Thanks
out
again,
for the
folks.
presentation. Thank you.
Thank you all. Good night.